Hello, everybody. My name is Adrian. This is my mentor, Bob Baptiste, and welcome to the Property Playbook. Today, we're going to talk about real estate investing 101. Let's go. So, Bob, you've been in the business for close to 32 years now, right?
33, actually.
Oh, nice.
Yeah.
So you probably have quite a lot of expertise and knowledge in, real estate investing.
Yeah, as a matter of fact, part of my own game plan has been to, in my process of selling real estate, which I've been involved for 33 years, as we said, I've done well over 1,000 transactions in my career, is to take some of those commission dollars and really put them to work. And what I mean by that is to acquire investment assets that will generate a passive revenue that I can utilize for myself, my family during my lifetime, and then pass along to the next generation.
So when you first started, this question is going to be, about the newer generation of people who's trying to get started, right? The newbies. So,
Yes.
What are some strategies that you think that they can do to work on now to kind of get them in shape into getting their first property?
Okay. Well, there's a couple of things that newer investors can do. One is to say, okay, look, go to people that are close to your family, your parents, your aunts or uncles or something, and say, look, let's get together. Let's pool our resources together as a family and let's get into owning a duplex. Start with something small, but it needs to be multi-unit asset, not single family. But you go to your family member and say, look, aunt, uncle, mom, dad, whomever, you put in some capital, I'll put in some capital, I'll manage the property, I'll deal with the tenant issues, I'll deal with all the improvements, I'll take care of everything. You put in some money and then we're going to service the debt, which means like the rents, pay all the debt services, and then the money will be split in profits based on whatever arrangement that you come up with. This allows you to get into the game a little bit sooner as opposed to waiting to save your own money, which could take a season of time. So this will be one way that'll put us into a property virtually immediately. Okay. Another thing that I recommend for some of my younger investors is to say, let's get mom and dad or our own money if possible, and let's buy a duplex. And then I'm going to live in one side, and that's going to be my primary residence. And typically that's going to be a 2-bedroom, 1-bath unit with a 1-car garage, preferably. And also I always recommend pitch roof. That'll be much easier for maintenance purposes, but you're going to reside in one side of the asset and you're going to collect the tenant rent, and that's going to support about 60 to 65% of the debt service. So you're going to have a tenant on one side, you're going to be on the other side. Okay.
Right.
So if you do that, typically you're able to put yourself in a position where you can actually get the tenant's rent, and your portion of contribution is going to be less than if you were renting an apartment from some other third party. And obviously, you control ownership and interest of that asset, which on the long term is going to provide much more valuable financial outcome for you and your family.
Right. And I sense that, you emphasize on the duplex, right? So, aside from renting out one and living on the other, what other benefit do you see from, living in a duplex? Because, why is it always a duplex and not a single family or like a condo?
Okay. Well, generally here's a rule of thumb, and this is my own personal belief based on my experience, is that when you own single door units, that's condos, single family homes, townhomes, things of this nature, you have one front door. So that means 100% of your rent is dependent upon that one tenant.
Correct.
If that tenant doesn't pay, you've basically jeopardized 100% of your rental stream coming from that tenant.
Right.
So if you have a duplex, you're going to have 2 units.
Right.
You're going to have a tenant on the left and a tenant on the right. Now, if one tenant stops paying, which on occasion can happen, you've only lost 50% of your rental income. Not only that, but you're going to generate far more rent, because a 2 units is going to generate, in this marketplace, roughly around $2,500, $2,600 a month per unit, versus a single family dwelling or a condo or something like that, which might be around $3,400, $3,500 a month. So you'll generally anticipate about $1,000 a month additional revenue with less exposure to lost rents, and that's going to be a much better situation for us.
So risk management
For sure. And then, more importantly, is that when we get out of owning condos, and I don't recommend condos and townhomes for rental, because you're getting away from homeowners association fees. And those can be anywhere from $300 to $500 a month, which absolutely cut away at the net profit on your bottom line. So we want to avoid that at all times if possible. And more importantly is the higher the density of the asset, the lower the cost basis per door. So let me give an example. A single family home, generally, let's just say hypothetically in this region might be $1 million.
Correct.
Okay. So that is $1 million investment for one door. As a duplex, you might buy for $1 million, you're going to get 2 doors.
Correct.
So you're getting a basis of $500,000 per door times 2, which is $1 million. So you cut your cost basis in half for each door that you own. And then also you're reducing risk because you have 2 doors for rent instead of just 1. So this is going to be a much better long-term play for you.
Gotcha. And what are some common mistakes that you see people make when they first start investing?
Well, some of the mistakes that people make, is the primary one is always that they're buying the wrong assets. They're buying single family homes, condos, townhomes, things of this nature, which have HOA fees, or they might hang on to a house that they might have bought and then they saved up some money and they acquired a second home. So they took the first home and they make it a rental. You know, those types of things, although, you know, it's certainly nice at the end of the day, most times they're barely breaking even or sometimes even carry a slight loss. So whatever we're investing in, whether it's stocks, bonds, real estate, we have to have a certain minimum net return. And, you know, generally we're trying to get 6 to 8% conservatively on those numbers. So if we're not getting 6 to 8% return on the asset, then we shouldn't own it.
All right.
We should not own it in our portfolio. So if you had as a primary residence, you've converted it into a rental, I strongly recommend that asset gets repositioned via a 1031 exchange, and that's a whole nother conversation, but we'll talk about that later, into a higher density asset, maybe a duplex, maybe a triplex, because this will in turn generate much more revenue. And at the end of the day, it's all about revenue and profitability.
Right. And then when you say about, 4 to 6% of return, right?
Yes.
We're just pretty much just trying to beat inflation at that point to gain some more, to get your money getting work, correct?
Exactly. Because if inflation is going up at 4%, which the government says roughly right now about 4%, and we're getting a 3% return, we're losing money.
Yeah.
We have to stay ahead of the curve to gain. The intent is to move forward, build our portfolio over time.
Right.
And so we have to get minimum returns. If we're not getting minimum returns, again, we cannot own the asset. So if you have an asset and you can run the numbers on that, see what's the gross rent, what's the expenses associated with that, and we can determine through a mathematical equation what the profitability is. Yeah. If it doesn't meet the standard where we're generating a certain minimum profit, then it's not an asset that we should control. I always tell the clients, do not get emotionally attached to your stuff, because at the end of the day, it's just stuff. It's a vehicle for us to derive revenue and build long-term wealth in doing so.
Correct. Yeah. So would you say that when you first started, investing in real estate, maybe the interest or the income return, will be substantially less than what you were to have maybe 5 or 6 units. So for example, right? When we first start, investing in duplex, our return, the income return will probably maybe be just a little bit above the inflation rate, and then the higher of the density will probably have a greater return. Is that correct?
Exactly. As we move up in density, as we move up in unit count, then our return on investment should increase. For example, if you took a duplex that you bought it for $800,000, I'm using round numbers, and then you held on to that for maybe 2 years, and then now you say, oh, I can sell that property now for about $1.1 million. I can take this profit, use a 1031 investment vehicle to transition that asset from the duplex to a higher density property, which would probably be 3 units or 4 possibly. And we can defer tax. That means there would be no tax on the immediate transactions. And then we can increase our door count. So now we've taken this $300,000 gain, we've acquired another door. So instead of having 2 doors, we've got 3 doors. Now we're deriving $2,500, $2,600 a month times 3 instead of times 2. So over seasons of time, if we're using equity to move up or step up in our unit count per transaction, then we're going to have greater income streams, which increases our overall profitability.
Gotcha. Okay. What other things that you might want to touch base on, the first?
Okay. To make this really simple for investors, here's my recommendation: to gather together what resources you have available. Speak to a licensed representative like an Adrian or myself or somebody close to you and say, look, I want to get started in the investment pool. How do I make that happen? And we will sit down and create a strategy, a plan for you to go from step A to step B to step C to the point that you can literally get into your first investment asset. Now, remember though, these plans are not predicated on one door or one set of doors, I should say. They are based on a lifetime of transitions from a duplex to a 4 to a 6 to an 8 to a 10. If you were able to own at the end of your season 10 doors, and each door is generating $2,500 a month per door, you're going to have a substantial income that's going to help supplement whatever pension retirement assets you've been able to accumulate. I know this, I'm living proof. So feel free to reach out, ask for guidance, ask for assistance, but the key thing is time. You have to get started as quickly as possible. That would be my professional recommendation.
So thank you for all the information. I think we touched based on a lot of, additional topics like 1031 exchange, how can we crowdsource some funds to get our, real estate investment, going. And, I think that these are going to be a great topic that we can elaborate on in the future, podcasts. Absolutely would be glad to have you back and chat a little bit more. So if you like this content, feel free to subscribe and see you next time.